Welcome again, everybody. For the next half hour or so, we're going to talk about navigating through chaotic markets. I think everyone can appreciate that under the best of times, markets are somewhat chaotic. And in 2023 and 24, we actually had great markets. This year is a little bit different. And our theme today is going to be to talk about how we think about difficult markets, how we've been managing through them. And we're going to spend time on, I'm just going to say the idea of American exceptionalism. That's something that's come up this year. We're going to talk about our views on the economy, and we'll talk about our outlook. With that, I'd like to introduce the Roundtable members, and just going from my left, Peter St. Dennis is sitting next to me. Peter is a senior portfolio manager and will be our moderator today. Next to Peter is Parker King. He is a quantitative and risk strategist for us. And next to Parker is Kristin Ketner, who is a senior portfolio manager and does a lot of our stock picking and equity analysis. I'm Paul Jablansky. I'm the Chief Investment Officer at AAFMAA Wealth Management and Trust. And it's my pleasure at this point to hand the mic over to Peter.
2025 has been an interesting year with a significant volatility in the markets, largely related to tariff announcements. The volatility index, or VIX, increased from 21 on April 2nd to 52 on Liberation Day, which was April 8th, before the 90-day pause was announced on April 9th. April 2nd was marketed as Liberation Day, which is an interesting term for the announcement of tariffs, which are essentially taxes. The tariffs that were announced were significantly higher than expected, which resulted in a negative response by both the stock and bond markets. The S&P 500 fell 12% from April 2nd to April 8th before the 90-day pause was announced. Prior to that, the market had fallen 8% from its February 19th high to April 2nd, for a total drawdown about 19%. The market, following the tariff pause, has rebounded 22%, and the pause will expire on July 9th while negotiations continue. In the bond markets, the 10-year spiked 50 basis points between April 4th and April 11th, which is the third largest move in a one-week period since 1990, only behind the 50 basis point move during the long-term capital implosion and a 54 basis increase in November 2001 when Enron was blowing up. The one-week increase in yield in April would have been equivalent to a 4% decline in the price of a 10-year bond, which is quite significant. Now I'm going to ask Parker some questions about American exceptionalism and Liberation Day. Liberation Day was the beginning of much of the market chaos that we've experienced lately. Since there's been a great deal of discussion about the decline of American exceptionalism. How do you define American exceptionalism, and is it still a valid framework in 2025?
Thanks, Peter. You guys have probably heard of American exceptionalism. It seems like it's getting thrown around a lot, and I don't know what the definition is, but I'll give you my definition. As far as I'm concerned, American exceptionalism is about the growth, the outperformance that we've seen over the last 20 years. If you go back to the mid-2000s, we had technological innovations, a lot of it around the internet, and basically the U.S. had supportive regulatory policy, supportive fiscal policy, And we benefited from this technological innovation to the extent that the rest of the world did not. So what have we seen since then? We've seen significant outperformance of the U.S. equity market. And if you think about it, we have a significant home bias in the U.S. Why is that? The U.S. equities have outperformed all international markets, whether you're looking at Europe, Far East, Asia, whether you're looking at emerging markets. So not only have they outperformed, if you look at the risk level, they've outperformed with lower risk. And additionally, if you look at the correlation between emerging markets, between international markets, the correlation's been high, especially during periods where there's been downturn. So the bottom line is, over the last 20 years, international markets have not provided any diversification. You've been better off being fully in the U.S. So where does that leave us today? So a lot of the questions that we'll probably kick around today is about American exceptionalism. Where are we today? We're at a place where the entire world is overweight U.S. assets, overweight U.S. equities. And so, I think that's the million-dollar question. U.S. exceptionalism has gotten us here due to this dramatic outperformance of U.S. equities, outperformance in terms of growth. And is it an appropriate framework for 2025? We think that American exceptionalism still exists, but we think it's been dented a little bit recently. And so what are we doing about that right now? Whereas with we're kind of expecting, with what's been going on in terms of tariffs and whatnot, that there's going to be a convergence of growth in the world. The U.S. is going to be hit the hardest by the tariffs and the tariff policies that we've seen, and the convergence between U.S. growth and the rest of the world is going to narrow. And we think for that reason, whatever your allocation to international equities has been, we think, especially if you're underweight international equities, being more diversified and diversifying back into international equities to some degree is one way to deal with this question mark of American exceptionalism.
Kristin, do you have any thoughts on American exceptionalism's durability?
Yeah, sure. As Parker said, U.S. exceptionalism is alive and well, yet has been bruised this year, but still very much intact, we believe. U.S. companies are some of the best managed in the world, have the most profitable, fastest growing, have the highest returns on capital. Just as a point, the S&P's average return on equity is around 20%. It's low teens for the European markets. The U.S. has one of the best regulatory environments, which has facilitated growth. If you look since 2010, the U.S. markets have grown, or the U.S. economy, I should say, has grown by 40%. Europe has grown at half that rate, and Japan at a third that rate. I mean, these massively underperform the growth here in the U.S. And despite the disruptive tariff policies of this current administration, we're expecting some easing in certain industries of regulatory constraints, which should help provide an accelerant to growth. The U.S. has the most productive labor in the world. The productivity in the U.S. is twice the rate of Europe. These are very wide margins. And the deployment of AI, which is the U.S. leads in the development of AI and the deployment of AI, should actually help further the productivity gap versus the rest of the developed world. And also, finally, the U.S. has the largest and most liquid capital markets in the world. U.S. counts for 2/3 of global capital markets, which is, to Parker's point, why everybody owns U.S. equities. So the administration's policies have been disruptive, but they're not disruptive enough to derail the underlying pillars of U.S. exceptionalism.
Do you have any views on the concentration in the S&P 500?
Yeah, I'm sure you've seen in the media, and a lot of people talk about how concentrated the S&P is in a few number of companies. Top 10 stocks in the S&P account for third of the market cap of the S&P. But this is no different from other developed markets in the rest of the world. It's about equivalent to what the top 10 stocks in Japan are, a third of their market cap. And actually, if you look at China, Germany, South Korea, and France, the top 10 stocks in those markets account for 50% of the market cap. So the S&P is no different from other developed markets. It's large companies dominate these markets.
Back to Parker. The Trump administration has changed many U.S. policies. Can you begin by giving us some background on their tariff policies?
Okay. Kristin just about talked me into going back 100% into U.S. equities. Just background on tariff policies. All I can really say is it's been a wild ride. For us, it's been really difficult. Prior to April 2nd, we had a certain outlook for U.S. growth. On April 2nd, it got blown out the door. So on April 2nd, on Liberation Day, when the Trump administration announced what the policies were going to be, they were way more extreme than anybody expected. The other thing that had us scratching our heads is they were based on trade imbalance. It's not really about bilateral tariffs being unfair. So you had poor countries, say, for instance, Vietnam, that were getting hit with really extensive tariffs because they don't import anything from the U.S. Well, of course they don't. They're a poor country. They don't have the means to buy significant U.S. product. So almost immediately after that, I think it was very next day, April 3rd, you saw Navarro come out and say, not only are these, the tariffs were extensive, kind of 10 to 50%, depending on the country. And then Navarro said, these are non-negotiable. And what happened immediately after that? Well, we started to get a lot of equity market volatility. As Peter mentioned earlier, we basically had an equity market crash. And then by April 9th, we actually started to have not only really weak equity markets, but we started to have some dislocation in the bond market, which was really quite worrisome. You heard of hedge funds running leverage basis strategies that require a lot of liquidity in the bond market. That liquidity was becoming problematic, and that's part of what drove the volatility that we saw. So take those market dislocations. Also take into account that almost everyone on Wall Street looked at how onerous the tariffs were, and it was generally predicted that if tariffs stayed at that level, it would take us to a global recession. So on April 9th, we had yet another change when the Trump administration announced that the 10% tariff would stay in place, but the reciprocal tariffs would be delayed for 90 days. So, just in general, it's been very difficult to predict what growth is going to be through the end of the year. It's really been difficult to figure out what the impact on markets are going to be. I think at this time, what we're thinking is that we're going to end up with about a 13% effective tariff rate, and that is going to reduce global growth significantly. Within the U.S., we see it basically cutting. I think our 2025, Paul, you may have to correct me on this, but growth coming from about 2.8 last year down to at least 1.4, maybe below. I think Paul's forecast is a little bit lower than that. So you're going to see a conversion or a convergence of global growth. U.S. coming down a lot more towards the rest of the world, but we don't see us going into recession, I believe.
What impact have the Trump administration's policy choices have on the attractiveness of the US dollar relative to other major currencies.
Is that mine?
Yeah, that's you.
Fine.
Parker's our in-house FX expert.
Okay, so just in terms of our outlook for the dollar, before any of this happened, one thing, what's been going on since the beginning of the year, the dollar's been weakening since the beginning of the year. And this is after we talked about American exceptionalism. We've talked about what happened since the mid-20s. The dollar's been strengthening, significantly since probably the mid-2000s. This year, we've seen the yen strengthen against the dollar by about 10%. We've seen the euro strengthen against the dollar by about 10%. We think this trend is going to continue. And and I mentioned a little bit earlier, we are allocating to international to some degree as a diversifier during this period of uncertainty. And we think that weakness in the dollar or strength in foreign currency will be a tailwind to our international holdings. Okay, so as we're looking forward, we think the dollar will continue to depreciate. And a lot of it has to do with how did we get to where we are? We've had extreme international buying of U.S. for a long period of time. The entire world is overweight U.S. equities. And one of the things that we saw early this year was repatriation. If you remember, we had a really significant outperformance of international equities in January. I think a lot of that was repatriation. Foreign countries were looking at their exposure to U.S. assets, especially equities. They'd gotten really overweight. There was some need to rebalance, and so we had an initial kind of sell or outperformance of international equities. And so now if we're steady state, say even if there's no more repatriation, if we look at this expectation of growth, i.e. U.S. is going to go from maybe 2.8% growth in 2025 down to 1.4%. Then we see Japan kind of moving up to maybe 1% growth, Eurozone about 1% growth. That narrowing of growth differentials is going to attract the marginal dollar. I think will no longer be going into especially U.S. equities, and so that's kind of a portfolio flow argument. And then the other thing we need to look at is, and I'm not going to go. I'm going to let Paul, if we get this question, I'll let Paul go into this a little bit more. But we've had a rising current account deficit in the U.S. It's about 4% or trending close to 4%. In order to fund that current account deficit, two things are either going to happen. One, we're going to have to see higher bond yields, or we'll have to see a depreciation in the U.S. dollar. My thought is that we're in the 10-year yield, we're probably going to stay kind of stable, and that adjustment in the current account deficit will at least partially come from some further weakness in the dollar.
Okay. Now we're going to move on to questions about the economy with Paul. Where do we stand on inflation and unemployment, the two pillars of the Federal Reserve's mandate?
Thank you, Peter. So a year ago at the AAFMAA annual meeting, in our roundtable session, I remember saying that we think 2024 will go down as the year that the Fed nailed the soft landing, maybe for the first time ever. And they really did. Whether it was by luck or by skill, they managed the economy into a much better place. So as 2024 ended, unemployment was in a relatively good place, high 3%, maybe 4% unemployment. Inflation was coming down to the Fed's target. There's always that last mile. Getting to 2% from, say, high 2% can be difficult, but they managed all of that very well. So our view was that the economy was stable and under control. We go back to the April 2nd announcement, and it's not like nobody anticipated that there would be a tariff announcement. As Peter said at the beginning of the session, the announcement was expected, but the extent of it wasn't. And with the new tariff policy, our view on the economy has changed. So just to walk through a couple of numbers, and Parker previewed them to some extent. When we look at unemployment, and more generally, when we look at the economy, because there's so much uncertainty still, remember, there's a 90-day pause on the retaliatory tariffs. That doesn't end until roughly a month from now, the first week of July. And there's a second 90-day pause, which ends at the beginning of August, only with respect to China. So there's still a huge amount of uncertainty. And we've created two cases. A relatively good case, which would be tariffs in that sort of net 13% range. And then if tariffs are higher than that, how much deterioration could we see? Our best expected case for unemployment is just under 5% a year from now. So we're 4.2% today. Let's say we expect to be around 4.9%. In a much more difficult case, we think that could be as high as 5.8%. So roughly a percentage point different in unemployment over the next 12 months, just depending on how these tariff talks, how all of the tariff deals play out. And we're going to talk about this in a couple of minutes as well. But remember, the one big beautiful bill is outstanding, and we don't know exactly where that's going. We'll talk more about that. And the consensus on the street. So the Bloomberg terminal gives economists an opportunity to post their expectations, and they typically somewhere between 60 and 70, I'm going to say qualified economists post. Bloomberg consensus is for 4.5% unemployment over the next 12 months. Inflation, and I'm using core PCE as a measure. We think inflation's headed to about 2.7% under the relatively benign case, and maybe 2.9%. Not a big difference, but inflation is probably headed higher. And the consensus on the street is 2.9%. And then finally, and this is what Parker talked about a little bit, real GDP growth. Under our benign scenario, just under 2%. Let's call that 1.9. Under our more difficult scenario, could be as low as 0.5%. And so you're talking about roughly 1.5%. Well, in trader terms, bid ask on where the economy could be. 0.5% would be a pretty significant slowdown. The consensus is right between our numbers. It's about 1.4%. So just getting to the bottom line, we think unemployment is going higher. We think GDP growth is going lower, and we think inflation is going higher. That spells the potential for stagflation. And stagflation is a policy trap for the Fed, because under stagflation, if high inflation, stagnant growth, if the Fed lowers rates, which everybody is talking about, they could risk inflation going even higher. And if they don't cut rates, they can risk understimulating the economy and having growth go lower. Growth goes lower, that could become a recession scenario. That's not our base case. We think the economy kind of muddles along, but stagflation is a concern.
Okay. With inflation approaching the Fed's target and rate cuts expected, how should fixed income investors position their portfolios?
Right. So with the sort of the underlying backdrop that we just talked about for the economy, when we think about fixed income and fixed income, just the bond market, we always start with looking at what current market pricing implies. And how you interpret that's a little bit technical, but the current market is suggesting that short rates, meaning the Fed funds rate, the 3-month T-bill, the 2-year Treasury, will probably decline. And anything past about 3.5 or 4 years of maturity is expected to increase. And that's called a yield curve steepening. Under that scenario, and given that the high level of uncertainty, the way we're managing through this is by reducing interest rate risk. We're concentrating on again, it's a little bit technical, the middle of the yield curve. So somewhere in the 5 to slightly higher than 5% yield maturity. And then there are always two aspects to fixed income. One is where rates are going, and then where's credit going? Are corporations becoming riskier or less risky? And the short rate falling is probably associated with the need for the Fed to cut rates, which is stimulative and occurs when the Fed itself is concerned about the economy, and therefore that translates into a concern about credit. And so we would reduce exposure to high yield, for example, and focus on investment grade credit and U.S. Treasuries and mortgage-backed securities.
Yeah, you discussed it before, but maybe you want to discuss a little bit more the difficult situation that the Fed is in given current tariff policies.
Yeah, so well, like I said, the tariff policies are first and foremost associated with that level of uncertainty. And if we have higher tariffs, we would, as I said, higher than expected tariffs, we'd expect unemployment to rise more than it would have. But I think I pretty much covered.
Yeah. I
that.
know if you want to bring it up
Yeah.
a little bit more. Do you think we're closer to a soft landing, no landing, or recession risk still lingering?
So our base case, as I said, is not a recession. I think soft landing is not really relevant anymore. I think we're in for a slowly deteriorating economy. It's possible that it'll be even a little bit faster than that. Most economists forecast for global growth is much lower this year, and our views are consistent with that.
Now, the big beautiful bill. What are the impacts on the budget deficit and furthermore fixed income markets?
So it's probably no surprise to anybody that the answer to that question depends a lot on who you ask. Politicians, that is Republicans and Democrats, have a very different answer. The Democrats will tell you that the bill is going to add $4 trillion to the deficit over 10 years. And the Republicans will tell you that it's going to cut $1.6 trillion over the next 10 years. So how can both of those be true? Well, there's probably spin on both sides. If you ask economists, economists are likely there's a consensus among economists that the bill will add somewhere between, let's say, 1 and 4 trillion to the deficit. There's controversy because of the way that the Congressional Budget Office scores, is required by law to score bills. And I don't want to get into those details, but our view is that the bill will add to the deficit. Let's keep in mind that the entire federal budget is under $7 trillion. So adding a trillion plus over 10 years is pretty significant.
Okay. How vulnerable do you think the U.S. is to foreign buyers selling our treasuries?
Yeah, so I'm glad we're talking about that, Peter, because I know when I watch CNBC or other shows that talk about financial topics, they often say, well, somebody brings up, can the Chinese just sell all of their U.S. treasuries and tank the U.S. Treasury market? And the answer to that is complicated. But let's take a step back. Let's talk about who are the large owners of U.S. Treasuries to begin with. The U.S. Federal Reserve is the largest. They hold just under 17% of all of U.S. Treasuries. That's a very large number. Japan holds about 4%, and China holds about 3%. Now, probably 20 other countries hold amounts that are, somewhere between 0 and that 3%. At its height, Japan actually held about 19% of U.S. Treasury debt. That was back in 2004. And at China's height, they owned about 14%. So this was a legitimate concern, let's call it 15 to 20 years ago. Today, over that period, the U.S. Treasury is actually, under different administrations, has been very successful in diversifying the investor base. And one last comment on China. I said the relationship was complex, and it is. There's an ecosystem. And put it in the most simple terms, the U.S. buys a lot of consumer goods and durable goods from China. That generates excess cash in China, and China comes back and buys U.S. Treasuries with that capital. And so it's a codependent relationship, and a unilateral move by, say, China to sell its holdings would, one, hurt China on the way down because the price would decline, and two, it would disrupt that ecosystem. And so I think that the U.S., that this is not a real concern, and that the U.S. is not really vulnerable to foreign selling.
Great. Now let's move over to investments. What changes did we make to client portfolios following the April 2nd tariff announcement?
The word we've talked about throughout this session is uncertainty. And following that announcement, uncertainty skyrocketed. And our first reaction was that we needed to study and understand the implications. And we ultimately concluded that the new tariff paradigm would fundamentally change the international trading framework. And I think a lot of other people concluded that as well. Volatility not only increased, but it stayed high for quite a long time. And we made a decision to reduce risk modestly across our client accounts. Again, we created two scenarios. One scenario was, hey, this is way out of control. The world is ending. What would we need to do in an extreme environment like that? We have a playbook for that, but that's not the way we looked at the world. Our view was that American companies were probably disadvantaged by the tariffs. The tariffs, as we talked about, jeopardize global growth. And so we took risk back modestly. What does that mean? We reduced allocations to tariff-sensitive stocks. We increased allocations to stable defensive names. And for clients with fixed income exposure, we reduced our allocation actually to zero in high yield. And we increased our allocation to investment grade corporate bonds and to U.S. Treasuries and government guaranteed MBS.
Great.
Kristin, what specific changes did we make in the stock portfolios?
Yeah, so as Paul alluded to, we made some changes on the margin to our debt holdings and our equity holdings. Just to back up for a second, I wanted to just lay some groundwork in terms of our philosophy in terms of equity selection, stock selection. We are predominantly in our stock models. We have stock models and we have ETF models. Stock models are concentrated 50 stock or so portfolios, and the ETF models reflect and express the same investment considerations, but across many more companies. In the stocks models, we invest in large companies, predominantly US companies, that have strong market share and competitive positions, which translates into pricing power. Pricing power is key, and that have long-term growth prospects and that are trading at reasonable valuations to those growth prospects. So in terms of the changes that we made in our models, we didn't change the allocations in the models. Each model has a different allocations to equity and debt. We did not change those allocations. Equity allocations remain the same. Debt allocations remain the same. We changed the securities within those allocations. Within the equity allocation, we turned over maybe 20% of the positions. And as Parker alluded to, we took a position in developed markets outside the US, and we expressed that with an ETF, EFA. And then within the individual stock positions, we lowered our exposure to technology and specifically to the most cyclical semiconductor cap equipment manufacturers, which are under potential pressure from tariff and export controls and sectoral tariffs, which have yet to be hashed out, which is some of the uncertainty that overhangs this sector. We still don't know what those tariffs look like. So we exited Applied Materials and ASML Holdings. We added more defensive financials. Bought Berkshire Hathaway, 60% of their market cap is in cash, trimmed Morgan Stanley. We added more stable pharmaceuticals, AbbVie, J&J, and then we added stable businesses like AT&T and Waste Management, which are utility-like revenue, recurring revenue stream businesses. And all of these collectively accounted for 20% of the equity positions.
What are your high-level views on small and mid-cap equities?
We do not own any small and mid-cap companies. Small and mid-cap companies you want to own when growth is accelerating, not decelerating as we've articulated. We think it will in the back half. Tariffs are much harder for smaller companies to manage through because they tend not to have the pricing power of large companies. AI, artificial intelligence, is still in its early stages, and it will ultimately benefit small and mid-cap companies. But right now, those that are benefiting from it are larger companies, high developmental costs, put DeepSeek aside for a second, and early adoption of products and data and access to large quantities of data. These are what large companies have, not small and mid-cap companies. So we think large companies are going to benefit initially the most from artificial intelligence. So at this point, we don't think it's prudent to own small and mid-cap stocks.
And who do you think are the biggest winners in artificial intelligence in the market?
So AI is still very important theme to the market and to the economy, and probably one of the factors which has helped, other than the moratorium on 90-day moratorium on tariffs, of bringing the market back from the correction of April. AI is still very centered on tech stocks, and within tech, it's still centered on semiconductor stocks, NVIDIA, Broadcom, Marvell, for example. These are all stocks that we own. You're also starting to see the beneficiaries in software stocks. Microsoft, the largest software company in the world. You can see the benefits of AI and the growth that they're seeing in AI-related products. You're also seeing it in, we own Microsoft also. You can also see it in utilities and energy stocks. LLMs, large language models, which is kind of the backbone right now of artificial intelligence, are very power and energy intensive. They require a lot of power to run. So utilities and energy stocks, natural gas, we own natural gas stocks. We think, clean energy, that will be necessary to help power these data centers, which will house these LLMs, and utilities too. Some which have nuclear exposure, and some which are in regions where governments are inviting in data centers and the development of data centers. So we think that eventually AI tools will be deployed throughout corporate America, and they will benefit any company that deploys labor. So we're still in the early days of artificial intelligence.
What's behind the recent underperformance of the U.S. mega cap?
Well, we think that the U.S. mega caps underperformed simply because they were overowned. For the reasons Parker articulated, everyone was overweight U.S. equities. And if you're overweight U.S. equities, you're overweight U.S. tech because they're such a dominant part of the S&P. So when investors lightened up on the U.S., they lightened up on their biggest U.S. holdings, the Mag 7, the large U.S. tech companies. And we think if growth slows further, we expect it in the back half. If it continues to slow, there's a chance that the U.S. exceptionalism continues to be questioned, and that foreign investors could lighten up further on U.S. equities, which would mean U.S. tech would probably continue to lag.
Do you think DeepSeek kind of implies that we're losing our technical edge in AI?
Yeah, you may have all heard of DeepSeek. It's an LLM, a large language model that was developed by a Chinese company, which seemingly kind of came out of nowhere earlier this year. The large U.S. tech companies knew of it, but the rest of us didn't until the headlines hit. And it was a disruptive week or two. You saw NVIDIA, and Microsoft, Apple, all the large tech companies get hit by double digits, correct double digits. But we still believe the U.S. is in the lead, but the DeepSeek was a wake-up call for U.S. tech companies. They presumably developed this model at a fraction of the cost, and that's up for debate. A fraction of the cost of the of what U.S. companies, Meta and Google, are spending to develop these large language models. But that's up for debate because a lot of the tech people and executives in the tech industry think that they developed this DeepSeek model with U.S. chips that they got their hands on. But nobody can prove this. But U.S. companies, it's an open source LLM, so U.S. companies are actually deploying it. They're using DeepSeek. They're providing access to it, the software companies, their clients, and building it into some of their products. So it's still a concern, even though U.S. tech is still the lead. This questions how far in the lead U.S. tech is. And as NVIDIA's CEO Jensen stressed last week on their earnings conference call, he went ad nauseum to explain his dislike for these export controls, and pointing out that if this isn't going to keep China from catching up to us, it's just going to keep our tech companies from participating in a growth tech market, aka China. So he had quite a bit to say on the conference call about the tariffs, the export controls might actually put us at an disadvantage over time rather than an advantage.
Okay, now back to Paul. Given the S&P's high PE ratio and 2 years of strong performance, are we due for a pullback or continued growth?
Yeah. So it's funny because a month ago we would have had a very different answer just given where the equity market was. But as we talked about, 2023 and 4 were off the charts years for the U.S. equity market, up 25% plus in both years. And the impact of that was an increase, large increase in price earnings ratios. And higher price earnings ratios have historically been correlated with lower 10-year returns or longer term returns. So there's less evidence that PE ratios have an impact in the short term. And the way we look at it is our enthusiasm about stocks over the long term may be a little bit lower than it was, say, back in 2021 or the beginning of 2022. U.S. stocks over long periods of time do have very, a track record of very strong returns. So we still like U.S. stocks. And I think it's a good opportunity to compare the returns you can generate in U.S. stocks with the returns you can generate in fixed income. So while PE ratios were rising, the Fed was raising rates and interest rates in general went up. Today, if you own a 10-year bond, you can generate roughly 4.5% yield. Average return on equities is 8 or 9% a year. And if we think long-term, today's high PE ratios may bring that down slightly. All of a sudden, fixed income looks like an alternative to equities. We wouldn't suggest that everybody go out and replace their equities with fixed income, but to the extent that people want to make changes on the margin, fixed income now looks like an alternative to equities, where in the past, 2, 3, 4, 5 years ago, it may not have.
We're going to wrap it up there and open it up to questions, but just wanted to thank everyone for sticking around after lunch.